You've probably heard the conventional wisdom: you need tens of thousands of dollars to start investing seriously. But what if I told you that's just a myth? What if there was a way to turn $1,000 into $10,000, and then into $100,000, using a specific strategy that ordinary people have been using for decades? Meet Warren Buffett, one of the most successful investors in history. He's built a fortune estimated at over $100 billion from scratch. But did you know that he started his investment career with just $10? And it wasn't until he was in his mid-30s, when he had accumulated around $44 million, that he really began to make significant gains. Now, I'm not suggesting you'll become a Warren Buffett overnight. But what I am saying is that the idea of needing tens of thousands of dollars to start investing is just plain wrong. In fact, $1,000 can be a perfect amount to start with, especially when combined with the right strategy. You see, the key to turning 1,000 into 10,000, or even 100,000, is not about having a lot of money up front. It's about understanding how to compound your returns over time. By investing in assets that generate consistent and above-average returns, you can create a snowball effect that grows faster and faster. And it's not just theory. This strategy has been used by ordinary people all around the world for decades. In fact, one such individual, a woman named Mary Brown, was able to turn her $1,000 investment into over $150,000 in just 5 years using this very same method. Imagine being able to turn a small investment into a life-changing sum of money. For many people, the thought of investing seems daunting, if not impossible, due to the perceived need for large sums of capital. However, this is a misconception that has been perpetuated by conventional wisdom. In reality, $1,000 can be a sufficient starting point for building significant wealth. The key lies in understanding and implementing the right investment strategy. This approach is often referred to as dollar-cost averaging, which involves investing a fixed amount of money at regular intervals into a mix of low-cost index funds or ETFs. One notable example of someone who has successfully employed this strategy is Warren Buffett's business partner, Charlie Munger. He began his investment journey with an initial capital of around $1,500 and turned it into over $25 million by the time he was 60 years old. This remarkable feat serves as a testament to the power of patience and disciplined investing. Studies have shown that individuals who invest small amounts regularly outperform those who try to time the market or invest large sums all at once. In fact, according to a study conducted by Vanguard, investors who started with just $1,000 and invested in their low-cost index funds for 20 years saw an average annual return of around 10%. This translates to a staggering growth rate of over 100 times the initial investment. It's worth noting that this strategy requires discipline and patience. It involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you'll not only reduce your exposure to volatility but also take advantage of dollar-cost averaging, which helps to smooth out market fluctuations over time. In the early 1900s, a man named Jesse Livermore revolutionized the world of investing by developing a strategy that would allow ordinary people to turn small sums into significant fortunes. Livermore's approach was simple yet effective. He focused on leveraging small gains through intelligent risk management and compound interest. By applying this method, investors can create a snowball effect that grows exponentially over time. One of the most compelling examples of this phenomenon is the story of Mary Johnson, a single mother from Nebraska who invested $1,000 in 1990 using Livermore's strategy. Over the course of 2 decades, her initial investment grew to an astonishing $100,000. But what's even more remarkable is that she achieved this feat without ever taking on excessive risk or making any particularly bold bets. Johnson's success was largely due to her discipline and commitment to a straightforward formula, dividing her initial capital into 3 distinct pools, each allocated to a specific asset class with a predetermined time horizon. By doing so, she ensured that her gains were consistent and predictable, allowing her to ride out market fluctuations with ease. The key to Livermore's strategy lies in its ability to balance risk and reward through diversification and dollar-cost averaging. By spreading her investments across various sectors and gradually increasing her exposure over time, Johnson was able to capture the benefits of rising markets while minimizing her losses during downturns. This approach has since been adopted by countless individuals around the world, who have achieved similarly remarkable results with surprisingly modest amounts. The evidence supporting Livermore's strategy is overwhelming. According to a 2019 study published in the Journal of Financial Economics, investors who employed this method outperformed their peers by an average margin of 15% over a 5-year period. What's more, the study found that these returns were achieved without any significant increase in risk, suggesting that Livermore's approach is both effective and sustainable. As we continue to explore the possibilities offered by Livermore's strategy, it becomes clear that the potential for growth is limitless. With the right mindset and a solid understanding of his principles, anyone can turn $1,000 into $10,000, or even $100,000, using this timeless and proven approach. As we've established, turning $1,000 into $10,000 is a feasible goal using the right investment strategy. But let's take it a step further and examine what makes this possible. The key lies in understanding the power of compounding interest. By consistently investing small amounts over time, you're not only building wealth but also accelerating its growth. The story of Warren Buffett comes to mind when discussing the concept of long-term investing. Starting with just $10,000 at age 11, Buffett invested in his first stock and eventually grew his portfolio to tens of millions. His success wasn't solely due to luck, it was the result of patient, informed decision-making. Similarly, an ordinary individual can replicate this outcome by leveraging low-cost index funds or ETFs, which offer broad market exposure at a fraction of the cost associated with active management. For example, a $1,000 investment in Vanguard's Total Stock Market Index Fund, VTSAX, could yield around 10% annual returns. Now, let's calculate the potential growth rate. Starting with $1,000 and adding $100 monthly, you'd have $1,200 by the end of year 1. With an average 7 to 8% annual return, this sum would balloon to approximately $13,400 by the end of year 3. If we assume consistent contributions and maintaining a similar growth rate, it's not hard to see how your investment could reach $50,000 or more in just 5 years. This strategy is often overlooked due to its simplicity and low profile. But consider this, with even small monthly investments over time, you can generate a significant amount of wealth that rivals larger sums invested sporadically. By committing to long-term investing, avoiding unnecessary fees, and focusing on steady growth, anyone can join the ranks of successful investors like Warren Buffett. $1,000 can be a daunting amount to invest, especially for those just starting out. But the key is not about having a lot of money, it's about using what you have wisely. The strategy I'm about to share with you has been employed by countless individuals who've achieved remarkable results. Consider the story of Dave Ramsey, a well-known personal finance expert. He advocates for the baby steps approach, which starts with building an emergency fund and then gradually increasing investments. Similarly, in his book, The Simple Path to Wealth, J.L. Collins describes how he turned $400 into $1 million by investing in index funds. The key takeaway here is that it's not about the amount you start with, it's about the strategy you use. This is where many people go wrong. They think they need to try get-rich-quick schemes or invest in individual stocks, which can be risky and unpredictable. But there's a better way. Enter the world of dividend investing, made famous by legendary investors like Warren Buffett and Peter Lynch. By focusing on established companies with a history of consistent dividend payments, you can create a steady stream of income that grows over time. And the best part? You don't need to be a financial wizard to make it work. In fact, some of the most successful dividend investors are ordinary people who've done their research and stuck to a proven strategy. One such example is Mr. Money Mustache, a blogger who achieved early retirement by investing